What's up, guys? Welcome back to my personal channel. Today we're going to talk about options. Yes, the first video I'm making on this channel, other than that little intro video that if you've seen it, I guess you've seen it, but yeah, I just filmed it like 2 seconds ago. Other than that, the first video is going to be about options, which are kind of complex and complicated and difficult to understand, but they're also not. So we're going to get down to it. I'm going to try to break them down very simply. I'm not going to go too in depth on anything, not going to start talking about delta and gamma and all of those other things and theta and that stuff, but kind of just give you the outline of the dynamics of how they work. So I hope this is helpful. Here we go. So just get a general understanding out there, and then maybe we can do a deeper dive into, buying call options, selling call options, buying put options, selling put options, in either 2 different videos or 4 different videos to really dive into the different strategies that you can sort of look at options and how I possibly trade them. So let's start off with call options. So call options, obviously you can buy and sell, but simply a call option gives you the option to buy 100 shares of the underlying Apple stock, and then you have a derivative, which is Apple call options and put options. So if you buy one contract for a call option for Apple, it gives you the right to buy 100 shares of Apple at whatever that strike price is before the expiration. Now, to the contrary, a put contract gives you the right to sell 100 shares of whatever the underlying is, so in this case Apple, at the strike price that you buy the put for. So let's look at Apple. It was trading at $122 and change today. If I were to, let's say 2 months ago, right, I bought an option contract a couple months out with a $100 strike price. What that means is I would pay a premium for that $100 strike price call option, but it gives me the right to buy 100 shares of Apple at $100 per share. So Apple's trading at $122 per share. That means I can go out, exercise that call option that I bought, buy 100 shares of Apple at 100, and I'm in the money by $22. So that's fantastic, right? Now the other thing you can do is you can just buy the option contract. If Apple goes up in value, that contract gains intrinsic value, and you could just sell that call option for a profit as well. You don't have to exercise it and buy 100 shares of the underlying, and that's the key here. You might not have the money or the capital to buy 100 shares of Apple stock, but buying that call option gives you the exposure to 100 shares of stock moving up. Now, if you want to sell call options, typically, at least the way I do this, is I sell a covered call, which means if I own 100 shares of a stock, I can sell one contract per 100 shares that I own of that stock. And what this does is it's a way to generate extra revenue, or it's similar to where some people get paid a dividend from some stocks. It's a way to generate more cash flow, and I can dive into this in another video. But the other way is to sell a naked call. And this is dangerous because by selling a call, what you're doing is you're taking the other side of that person buying a call. So if I bought a call and I have the right to buy 100 shares at a given strike, that means the person who sold it has to sell the stock at that same strike. So let's say you don't own 100 shares of Apple, and Apple goes up to $122 a share, and you were the person that sold that 100 strike Apple contract to me. And I want to buy those shares now because my call option's in the money. I have the option to exercise that contract and buy 100 shares of Apple at 100. That means you, the seller of that contract, would have to sell me the stock at 100. And since you don't own it, you have to go out into the market and buy 100 shares. So that means you have to buy 100 shares of Apple at the market price, which is $122, and then sell it to me at $100, because that's in that contract, right? It says you're going to sell me 100 shares of Apple at $100. So that doesn't make sense. Why would you do this? Well, let's take another example. Right now, say stock's trading at $122. I think the price is going to appreciate over $125. So I buy 125 strike call option, thinking that if it goes above that, I can exercise my contract, buy it for 125 a share. You think that it's not going to go above 125, so you take the other side of that contract and you sell that contract to me, saying that you'll sell me Apple stock at $125 a share upon expiration or before, because you think the stock's going to go down. So you as the seller get to collect that premium. So let's say I pay $100 for that contract. You get $100 in your pocket. Now if the stock goes down, that means that I lost my $100 because it never went above 125. I can't exercise the contract, so I can't buy the stock for 125. You just keep that $100. So now that goes back to my point of, if you own the stock, you don't have that upside risk. So if you owned 100 shares of Apple and it went from $100 all the way up to 122, you don't have to go out into the market and buy it for 122, but you lost out on that upside. So those are two different ways to trade call options. I hope that made sense. If it didn't, ask some questions and I can do a further in depth of just call options, just buying or just selling in the future. Now put options, those are sort of the inverse. So think of it as protection, a put protection, right? So when you buy a put contract, it gives you the right to sell 100 shares of stock at whatever the strike price is. So let's again take Apple as an example. If I owned 100 shares of Apple and it's trading at 122, I might want to buy protection at, let's say, $120. I want to buy a 120 strike put contract saying that if the stock trades below $120, instead of selling it at $100 a share, $90 a share, $80 a share, I bought that put contract. So I can say, well, I own 100 shares of Apple. It's now trading at $80 because the whole market sold off. But because I have that put contract that says 120 strike, I only lost $2 from where the stock is trading today, and I can sell my 100 shares at $120 to the person that decided to sell that put contract. So that goes back to the other side of the equation. If you were selling that put contract to me, right? Say you sold the 120 strike Apple contract. What you're saying is that you will buy Apple stock at $120 a share if it's trading at or below $120 by expiration and the buyer decides to exercise the contract. Now, if the stock keeps going up and up and up, similar to with that call option, you would just keep that premium. So again, if I paid $100 for that contract and you sold it to me for $100, I would give you the $100. You get to keep that $100 of premium. If the stock just goes higher, I'm obviously not going to sell it at $120 because it's trading at $150 now, so I'm not going to exercise the contract. I would just sell it in the market for $150. But by buying that put contract, I had that protection, that peace of mind, knowing that within the next 2 months, 1 year, 5 years, whatever it is, whatever that time period is, the expiration date on that contract, I can sell my 100 shares for $120. So it gives me downside protection as an owner of the stock. Now, for you, for example, let's say you want to buy this stock, but you think it's too expensive. It's trading at $122, but you're like, I'm not paying more than $120 for this. What you can do is you can sell that put, like I just mentioned, and then you just collect premium. So you would get that $100 that I paid for buying that contract. And if the stock happens to go below that, it means you now get put the stock, or I am selling you the stock or putting the stock into your account because you sold the contract and I bought the contract. I am exercising it and selling you my stock for $120 a share. So as someone that thinks the stock's going to go higher, you just don't want to pay that premium of $122. You can sell a put contract. So I can get into that more in depth, but it's a way of owning the stock or collecting a little bit of money because you don't want to buy the stock at the current market price, but maybe you want to buy it for something less than that. So it's a way to collect premium, still have some exposure in the sense of collecting premium to the stock, but you don't think it's going to go higher, all that jazz. We can get into that in another video. I hope this was sort of helpful, but the gist of it is call options represent the ability to buy stock at a given strike price, and put options allow you to sell stock at a given strike price. That's if you're buying either of those two things, so if you're buying a call or buying a put. And then you obviously have the inverse. Selling the call means that you have to sell the stock to somebody at a given price, and if you sell a put, you have to buy the stock from somebody at a given price. So, you know, there's a lot of moving parts here. There's obviously 4 different ways to trade call options: buy, sell calls, buy, sell puts, but they are very helpful, very useful, and can actually lower your risk or lower your exposure to a stock, and at the same time also increase your exposure and increase your risk appetite if you want to make more money on a certain position or a certain event that's coming up or whatever it is. So by using options, you can leverage yourself. You can also play stocks in different directions. If you have options trading approval, what it can help you do is put less money to work in the market but have greater returns. However, you have to think about the risk as well. So we can also talk about that in another video. It's a way of sort of having leverage. I hope that was helpful. I don't know if it was. It obviously made sense to me because I'm the one saying it and I know how options work and all that stuff, but I'm trying to talk about it on a very, very simple level. Not getting into the delta, gamma, theta, all that stuff, because honestly, I don't really look at it. I look at it from a risk reward. What do I want to get out of this trade? Where do I think the stock's going? That kind of perspective. And for me, I just don't need all of those like Greek letter things that are going on that just make it that much more complicated. If this video was helpful, please consider giving it a thumbs up and subscribing to the channel. It would really help me out. Would really appreciate it. But let me know in the comments what you guys want to know more about, if there's a topic I can touch on more. If you do want to see a specific video on call options, on just buying call options, on just selling call options, or conversely with puts, I can do that as well. I'll probably do that at some point in the future, but if people are definitely interested and I see a ton of feedback in the comments, I will do that sooner rather than later. Anyways, I hope you enjoyed this. As I said, like and subscribe, would really appreciate it. But that's going to be it for this video. Until next time, guys, thanks for watching.